to energy markets. We begin this hour with stocks near all-time highs as markets look through tariff threats. Jim Bianco of Bianco Research is watching 10-year bond yields and writes the following. If rates are steady, then 10-year bond yields should continue sideways before heading above 5% and the curve will steepen. Jim joins us now for more. Jim Bianco, I want to go to a quote from Michael Hordern of Bank of America and get your thoughts on this take this morning. We say hot 3% US CPI in January is a blessing in disguise for both bonds and stocks. Michael and the team go on to say rising inflation means Trump must go small, not big on tariffs and immigration in the coming months to avoid fanning a second wave of inflation. Jim, would you agree with that take?
No, I would not. I mean, we all know the phrase is you're supposed to take Trump seriously, but not literally. And that's what I think we've seen in the market in the last 24 hours. They're torturing themselves to basically, you know, micro read what Trump has said, but take him seriously. He intends on doing tariffs, and we are going to get tariffs, and they're going to come. And as much as we want to try and talk ourselves out of it, they are coming later this year. And I might add, markets get things wrong all the time. It convinced itself in January 2020 COVID wasn't going to be anything, and it was. It convinced itself in August of 2020 that, you know, the yen carry trade unwind was the biggest deal we've ever seen, and it wasn't. So it gets things wrong a lot, and take Trump seriously.
So, Jim, with that in mind, as you look at bonds and stocks, and you look at stocks close to all-time highs and bond yields near the low end of the range for the year so far, what do you think is more vulnerable?
Oh, I think the bond market is probably more vulnerable at this point. The hot CPI number, I think, is still a tell that at least at a minimum, the road to 2% is now, you know, we've been talking about the last mile for 2 years, and we're probably going to have to talk about it for another 2 years before we get there to 2%, that we've got sticky inflation. And if we've got sticky inflation, the Fed is probably going to be done cutting rates, if not maybe one more this year, although I think they might be done for the year, meaning that the funds rate is still going to end the year with a 4 handle on it, even with one more cut. And if the yield curve continues to steepen and we see some kind of normalization of the curve, which we've been seeing for the last several months, that means that you could be pushing the 10-year yield above 5% sometime later this year. And I still think that that's in the cards.
Jim, when you take a step back, it feels like it's a little bit of a numbing environment. There is so much noise. You have, on one hand, about 3 days ago, we were talking about that inflationary risk, and you would have had a lot of compatriots talking about 5% Treasury yields. At the same time, you got inflation data that looked bad on the surface, but people got enough comfort from the individual details to say, actually, this means that disinflation is intact. How do you strip out the noise and have conviction about an inflation call and the possibility of expectations getting truly unmoored?
Well, I think if you look at the way that the markets have been trading, and if you say start with the stock market, the S&P is at the higher end of a range it's been since 2 weeks after the election. It's been trading in about a 5,800 to 6,100 range for, like I said, over 2 months, and it's just at the top end of the range. And the same thing has been happening with the bond market, too. On November 15th, we were at 450. We're 453. We ended the year at 456. So there's a lot of noise, and the markets move around a lot. Yesterday was a big individual day in the stock market, but the trend is still sideways. And that says that that's still a market that is, you know, has little conviction or is unsure of where to go next. So it sees all the news, and it's not really reacting to it other than having big days here or there, but moving sideways. And I think ultimately it's going to give away to there's going to be tariffs, there's going to be a little bit more inflation, and interest rates are going to go higher.
Jim, when you talk about the inflationary impulse, are you really attributing that to policy? Or do you see something in the internals of the data that a lot of people are just dismissing as highlighting some sort of pressure that everyone is closing their eyes to?
No, I see something in the data. Every time we have a financial crisis or recession, and we had both in 2020, the economy changes. Change is not worse. It's not dystopian. The big change that happened in the economy coming out of 2020 was remote work. Over a quarter of the country is now doing remote work, and we know what Jamie Dimon's attitude about that is from a couple of days ago. He doesn't like it at all. But it is here. It is not going away. And that is a fundamental change, not only to the way we work, but also to the way we live our lives. And I think that that is building excess pressures on prices and leaving us with higher inflation. Not 8, 10 or Zimbabwe inflation, but more like 3 to 4% inflation. And core CPI just finished its 45th month in a row above 3%. So we've been seeing that kind of pressure, although we continue to try and tell ourselves that, no, we're going to go back to 2%, that, we're going to return, as Jay Powell says, to a pre-pandemic environment. The cycle changed, and we're in a different cycle right now.
Jim, I just love to quickly get your thoughts before we end on what you actually think is going on with tariffs, because you say the market should be taking Trump seriously, and they didn't, but he didn't actually sign anything formidable yesterday. It's an investigation into these countries. There was not a single tariff placed yesterday, and my read is that he's in negotiating mode to get some sort of concessions, especially out of the European Union. Would you not agree with that?
Yeah, I think tariffs are leverage, and I think they are big leverage. And I think that when it comes to negotiating with our partners, whether it's Canada, Mexico, or the European Union, Trump holds more cards than they do. And I think that these tariffs are a threat, and he wants something else. Now, in the case of Europe, I think what he wants is he wants more security arrangements. He wants them to spend 5% of their budget on defense. And he even said yesterday he wants them, when they're spending 5% of their budget on defense, to buy more stuff from defense makers in the United States. So I think that all of this is more leverage than an external revenue service to raise revenues. I think he wants some of that too, but I think it's really about negotiating, and we need to understand that that's what he's trying to do.
Hey, Jim, great to kick off this morning with you. Appreciate it. Jim Bianco there of Bianco Research. We'll talk about Jamie Dimon.